continuing on videos on some little things that help us make trading decisions. If you like this kind of video, make sure to subscribe, like, comment, and share. Would really appreciate your feedback. Now let's get started on the topic today, market making basics. Okay, so we're going to take a look at what a market maker does in its simplest form, and see how they make money, and maybe look at the ways they would lose money. To go through the basics, a market maker is a company or a person, an entity that is trying to make money by capturing what's called the bid-offer spread. Now I'm going to start with the basics and use an example where a market maker may have some USDT or access to USDT on margin, and also some ETH, move away from our usual Bitcoins, and they also may have some ETH or ETH again on margin. So a market maker is probably a trader like any of us, and has some in crypto. They will have maybe some dollars or stable coins and have some ETH, or ETH can be replaced by any other coin. So, and this is what a market maker would do. So a market maker has some ETH, might have some USDT. What they would look is they will look at the trade book, and the trade book may have other market makers in there, but we won't go over the combination of all the market makers. So when you look at the trade book, you usually see some offers, the prices, and maybe some amounts. So there's the amounts of how many ETH may be on sale, how much are like to be bought or wanted to be bought, and the prices that correspond to the orders of the sizes. What a market maker will generally do is they want to capture the bid-offer spread and basically tighten the liquidity, or at least increase the depth, the amounts on the bid and offers. And this is how they provide a certain advantage to the ecosystem, and also a way for them to make money. So what a market maker may do is they may see a trade book with ETH. Again, in the real world, this is far more liquid than what it is here. But for example, we'll just take a look at a very small trade book. What the market maker may do is find the ETH, and for example, they may offer 10 ETH at a price of 2005 USDT, which will make it its best offer. At the same time, because they want to capture this bid-offer spread, usually alone, they're bidding, a market maker may choose to bid 2001 USDT for 10 ETH. Now, I'm an old school type of guy, and not to really confuse when to buy or sell. In old traditional finance years ago on the floor, you would actually, when you want to sell, you would actually offer a quantity at the price. And then when you buy, you will name the price first for the quantity, right? This is so that you would avoid any confusions when you're trading quickly, or you need to communicate which side you are, whether you're buying or selling. So this is a little tidbit from the past. So you may find a lot of old school traders, like 50-year-old guys, maybe quoting these things this way still. Okay, so you have a market maker that will come in and try to capture this spread between 2005 and 2001 and creating a market there. So let's say that this offer gets kind of cheap enough where there is a price taker. This could be anybody that wants to buy some ETH. We come in and they'll buy the 10 ETH paying 2005 USDT. So the market maker will find themselves a little short or a little light ETH, and then because the taker has bought with USDT, they'll find themselves a little bit more USDT, what I'll call a small imbalance. So what will a market maker do next is the market maker will try to cover or buy back this ETH and still be able to make a profit. In order to entice a buyer to come in, the market maker may actually usually choose to raise the price of where they want to buy the ETH, in this case because they sold previously, to basically entice a seller to come in and sell them the ETH. So in an ideal world, maybe what you'll find is, or maybe what we would do if we were a market maker, is to offer the ETH and say the next offer, we would offer up at 2008 USDT. In fact, allowing the next offer to be, best offer, not particularly the market maker. And it'll try to cover back the ETH, possibly buying somewhere in between their sell price of 2005 and their original buy price of 2001. So they may increase the price of the bid that they had originally from 2001 all the way up to 2003. So, so they're trying to capture that $2 spread in ETH. And if they're able to find a seller that is, finds the price of 2003 good enough, a seller may come in and basically sell the 10 ETH at 2003. So the transaction where the market maker originally sold at 2005 and bought back at 2003 will be left a profit for the market maker. So let's see what the profit is. So again, the ETH they sold at 2005 USDT. Because they sold it for USDT, they received 20,050 USDT. And then soon thereafter, if this trade was all working out well, the 10 ETH was actually bought back at 2003 USDT, in which the market maker would have paid 20,030 USDT. I haven't included anything like commissions or anything like that may be possible. It's just to basically this video is to go over kind of what the mechanics of what a market maker is actually trying to do, which is to make this very small bid and offer spread. The net profit will be the amount of USDT they originally got from the sale, which is about 20,050 USDT, less the amount of USDT they paid to buy the ETH back, which will mean a total of 20 USDT. And this is a very, very thin margins. I think some market makers may actually be looking at very quick periods to make margins like this, but to make hundreds and thousands of trades so that these little bits and pieces add up. There's additional things that a market maker may actually look in where to offer their ETH or USDT, or where they'll choose to put their volumes, for example. They may be looking at things like how much the book depth is. Maybe it's there's stacked offers versus very weak bids. Then they may choose to try to sell a little bit cheaper, knowing that there could be some supply on the upside. By reverse, if there's a lot of strong buyers, they may choose to hide their offer, or even may not even offer first and try to acquire some coins first for stable coins. So they will be looking a little bit at book depth analysis. We certainly do when we market make a little bit. And then there'll be other factors as well. So we'll go over some risk factors next that is present in market making. So from our example, our market maker sold first, but what would happen after the market maker sold? What if the price goes even higher? Well, the market maker would have to cover a short at a loss. Thus, they would have to buy what they sold at a higher level. And after the market maker bought, if the starting point was to buy, after the market maker bought, what if the price goes lower? Well, the market maker may have to liquidate the long at a loss. So they would have to sell what they bought even lower. So, for a market maker, the optimal scenario is mean reversion. So the prices keep crossing a mean without a very fast trend. Breakups and breakdowns are the largest risk to market makers because they'll be holding on to the last trade when the markets will move significantly against them. So momentum is for a true market maker, momentum is actually quite bad. So a market maker will generally, again, look at book depth. They will also take a look at whether a certain asset is going through a mean reversion price action or a momentum price action. And what you may find is market makers will tend to widen their markets or even simply exit market making when the momentum is looking quite strong or quite weak, and wait for the prices to kind of settle down and then start market making again. At least this is the type of market making decision making that we would go through. So we would tend to avoid a lot of the fast momentum that's happening especially in minutes, for example. So market makers are definitely short volatility. They make a lot of money when basically the prices are kind of moving in a range. Market makers can make a decent amount of money in times of high volatility as long as there isn't a very strong momentum. For this kind of short volatility, is there other stuff that market makers do to make some revenue? And the answer is absolutely yes, especially in crypto. A lot of exchanges, especially derivative exchanges, offer liquidity maker or maker rebates from exchanges, which can help offset some of the losses from being effectively short vol. And there's other economic incentives that's probably given from exchanges to market makers on an ad hoc basis. Those things may include some extra leverage, maybe some extra, much lower commissions, even on the trader side. There could be quite a few things that is given to the benefit of to the market makers themselves. So next time, we will go over a little bit more of market making from an automated way, or AMMs, which is present in DeFi. So at least in the beginning, you'll have an example of what market makers do, and we'll use this video as kind of a base or a springboard to jump off into looking at some of our algos that we may introduce, including maker taker, which in one side is actually trying to be a market maker. So I hope you enjoyed the video. Please check back next time, and I hope we can, these things are still of interest to you guys. Okay, thanks.